Hello and welcome to this week's interview with a FX superstar. We are here with one of the original old timers, Mark Smith. Mark was one of the founders of the very first ECN, electronic crossing network that was used, which was MatchBook FX. But that wasn't even his first one. He goes before that back to other ECNs. Next Trade, he was one of the co-founders of Lava FX, which sold to Citibank. He worked for Trader Tools. He's got an FX consulting business now. Mark, welcome to our the second show on our weekly interview series.
Thanks for having me, Ty. I'm excited to join you. And after listening to Breakfast with Buyside, if you guys haven't watched that or listened to it yet on the podcast, you should tune in. I'm happy to be able to join you and give you a little bit of my expertise in FX.
Well, I'm really looking forward to this because now that you are, I'm going to call it out of the market. You've been the insider. You're outside of not. I've got no idea whether you're going to be, the go-go rah-rah cheerleader, or you're going to be the expose, WikiLeaks, letting it all loose. But in any case, let's see. Well, I think one with the sort of let's just talk about how ECNs work. How do they make money? Give me the business side of how an ECN. By ECN, it could either be a Reuters or an EBS or an FX All on that institutional side. It could be more of a, maybe less of a network and more of a back office. It might be like FX Connect. There's Integral. There's Gain, ParFX, 360T, Molten Markets, CurrentX, Hotspot. I mean, Bloomberg's got a couple of them. How do these guys make money?
Well, traditionally, an ECN is designed to make money based on transactions, on commissions, not to come in and adjust the spread in any way, shape, or form. To be able to be very transparent. When you look at how an ECN originally came to be, it was part of the rules, order handling rules in the world of equities back in 1996 when the first rules were passed. The very first kind of quote ECN was Instinet. And Instinet at the time was considered an agency broker. So they acted as agent and they matched buyers to sellers electronically and then charged a small fee for that.
And that fee is typically not, in FX world, is not a dollars per ticket, but rather dollars per million. It's a percent of done. So a 100 million trade makes 100 times more than a $1 million trade.
That's correct. It's all based on notional value, traded value.
Okay.
And there are several different models to look at to be able to build liquidity. The key of an ECN we'll talk about is liquidity. So there's models where you charge both sides, the maker and the taker as we call them. There's models where you charge just one side, where you just charge the taker. And there's models where you actually rebate the maker in order to entice them to bring bids and offers into the central limit order book.
Now the standard model, and I'm going to use that the buy side would see, not the interbroker, but is often described to them as you get this for free. The sell side, the guys who are making markets, build it into the price. It's free to you. You want to discuss that a little bit?
There's nothing free in the financial world nowadays. So I would question anybody who claims that their ECN is free. There's a price built in somewhere. Someone's making money. You don't invest all that money in technology and infrastructure and then give it away for free. I think that that's a manipulation of the way the market should work. Really, the spirit of an ECN is to be completely transparent. It's to provide transparency into an opaque market. And the FX market was very opaque when we came in with MatchBook in 1999 and introduced the concept of charging commissions. Everything was spread-based at the time. If you look fast forward now to 2013, there are still guys out there that are trying to manipulate the spread in order to be able to claim that their platforms are free, but the market is much more savvy nowadays, and people know that someone's getting paid somewhere somehow.
Well, this reminds me a little bit about the movie Casablanca, where people say, I'm shocked, absolutely shocked to hear there's gambling going on in this casino. We heard, I'm shocked, absolutely shocked to learn that fixings can be manipulated, or that the banks aren't giving me, the absolute best price in the market with no fees, on the older scandals. People know that there's a fee involved here, but first off, they rarely know how much that is. If you ask 20 institutional investors, how much do you get charged in total from the ECN and the markup, I will question if 19 of them know the answer to that one. And, or actually rather that one, or more than one or two know the answer to that one rather. But it also seems to me that the dirty little secret is neither the sell side nor the buy side want it out how much it's being made. That there's a, while you talk about transparency and ma, apple pie, you know, truth, beauty, justice, all that kind of stuff, that the sell side, especially a custody bank and the old model, want to bundle it all together as much as possible, and they won't say what the markup is. And that the buy side often doesn't want to know that the guy says, whatever you do, build my cost into the ticket price. I don't want to be a cost center. Let it go out to my customer. You got a reaction there?
Yeah, you know, it's interesting. The way I look at the markets all the time is that the premise is everybody's looking out for their own rational self-interest. So everybody's trying to maximize what they need to do as far as how they operate their business in the market. So the sell side, the buy side, you're seeing those things start to be kind of blurred. Who is the sell side and who is the buy side, especially in the world of ECNs. I think FX more than ever now has been bifurcated into sort of the trader mentality, the guys searching for alpha, and then the guys who are real money guys who have business to do. They need to do the business because it's either an offset of something else they're doing, or they've got payments they have to make, and they look at the market very differently. I think if you asked 20 high-frequency traders what they pay, all 20 would tell you exactly what they pay. They know to the mill what they're paying on a transaction basis. And if you ask the banks who are supporting those type of traders what their costs are to get them prices, they would know. There still is this crazy, I think, internal battle in FX to try to hide what the costs are, because vendors, platform providers, somehow think that if someone can look at a commission run and say, oh, I paid you $10,000 in commission last month, oh my goodness, that's too much, that it may hurt the platform. I disagree. I think that's a legacy mindset in FX, and I think you'll find there's a lot of legacy mindset in FX. And we're in this interesting phase where those industry professionals who've been around a long time are slowly leaving the market, and new people are entering the market with a whole new mindset. And I think you see that with Gil, who's leading EBS. Mm-hmm. And he has a totally different mindset of what was there before, and it shows in some of the things that they're doing and the way they're approaching the market.
Well, we're certainly going to get into that. Gil sent a interesting white paper out this week. I'm not sure when this program will come out, but we're going to discuss some of the things he talks about, what best practices should be in ECNs. But going back to this whole idea of soft dollars, I guess as is shown by our name, BuysideFX, as opposed to high frequency trader FX or alpha trader FX, that when I was talking about 20 people being interviewed, I'm talking with the operational, real money, often long only sides, who I will still say are in the dark and not necessarily always so unhappy about it. It's a little bit like Sergeant Schultz. I know nothing. Sometimes it's better not to know. And if you can justify, hey, I've got best price as shown to me, I don't know what that markup was. Benchmarking stinks anyway. No one knows anywhere. Let's just, I've dealt with it.
Yeah, blissfully ignorant, right? So that's what we used to say about those guys. And the interesting thing when you talk about benchmarking and you talk about what people know, and it's a lot easier to believe that you're getting a value for value transaction when someone says, don't worry, I'll take care of that execution and you'll get a good price from me, but I'm providing all these other services to you, and these other services, they're valuable, and I'm going to give you those services, and then you're going to allow me to execute this order, and I promise that you're going to get good pricing, and I'm going to give you a value for value transaction. And that used to be hard to define exactly what the costs were and who was getting the better end of the deal. Nowadays, with technology and discovering information, it's not hard at all. Some of it's flat out lazy. I consult for some of the guys in the buy side world that you're talking about, and you come across people who just they do it because they've been doing it for the past 20 years, and they're lazy and they're not willing to take the time and effort to really find out what those costs are.
Of course, that's not going to be any of the people listening to this show. They're obviously
absolutely not. And absolutely, they're the people who want to find products like BuysideFX to be able to solve these problems, right, and really understand what those are. So I just think that the market is still kind of coming out of that phase where this is the way we do it, and we accept that. And then you've got the other part of the market that says, no way, I owe it to my clients, my end customer, the end investor that I'm out here representing. I have a fiduciary responsibility to. I owe them to be able to get the real best price and the real efficiencies. And I think that's going to continue to see evolve in the market.
Well, before we get into best practices for ECNs, let's talk about just the current competitive marketplace. It's a pretty easy argument to say that the ECN function is a commodity. You mentioned before liquidity being the big driver. Are there any other differentiating factors? There's been, I think, some movement to say we're safe. We don't have any of those evil high-frequency traders. For an industry that's built on transaction models, that has meant providers have generally curried to those guys. What's going on now?
Well, it certainly is a crowded landscape. I mean, if you look at 2013 and you look at where we were in 2002 when we started Lava FX, it's a very, very different world.
You can even say 2011.
Yeah, absolutely. It's the barrier to entry from a technological standpoint and infrastructure standpoint to become an ECN in 2002, 2005, 2008 versus in 2013. It's completely different. You can get into the business at a much lower price point and have the right infrastructure and have the technology that we consider competitive, 1/10 of the cost that we experienced back in 2002. I think the market is way saturated. The concept of being safe, I think, is a complete misnomer. Everybody comes out with the idea that okay, we're going to have different pools of liquidity, and we're only going to let the sharks into this pool of liquidity, and over here we're going to have all the pristine liquidity. That's just not the case. That's a panacea. That's a dream world.
Why is that? Because you can't tell the shark from the lamb, or what? Why is that not viable?
If I'm the shark, I'm going to put on lamb's. I'm going to be a wolf in lamb's clothing, right? As much as I possibly can. I'm going to tell you I'm going to be a good guy. I'm going to tell you I'm going to be a sweet guy. I'm going to go in there. I'm going to actually make liquidity, and that's where the lines are blurred between buy side and sell side. There's a lot of buy side guys out here that have better technology than the banks. They can make prices faster. They're more efficient in the way they do their execution. So they say, hey, look, we want to provide liquidity. Providing liquidity is just a cloak to say that I'm going to put a price in there that I'm going to move so quickly that I'm going to be able to take advantage of mispricing in that pool. And pretty soon the guys who were the safe guys are now the guys who you're tagging and saying that's potential toxic liquidity, and then pretty soon you're moving them from the safe pool into the other pool. The other problem is building a pool of liquidity that is quote unquote safe is very, very difficult. Everybody wants that business. And banks on a single dealer platform basis are treating those people pretty well. Mm-hmm. They're doing a lot to keep them in that environment. And so what incentivizes that type of order flow to get into a pool where potentially they could be disrupted by bad actors? So if I'm going to build a brand new ECN and I want to come out and try to build liquidity, it's much easier to turn on an API to 10 high-frequency traders than it is to find one guy who's doing what they would consider, quality flow. And so, I think that the big issue in the ECNs across the board is phantom liquidity.
Let's discuss phantom liquidity. For those of the viewers who are a little shaky on it, explain what that is, please.
Sure, it's something that we experienced very early on, and you didn't quite think about it at first because there's only a couple of venues. But phantom liquidity is basically this. Let's say you're a bank, a major money center bank, and you've got great technology. You want to put your price out there, and you're approached by every single trading venue who wants you to participate in their venue and provide liquidity. So you decide that in Eurodollar you want to be 30-32, 2 pip spread. And you want to put that price out, and you want to be, 20 deep, $20 on each side. Now, if you are doing that to 10 venues, you're all of a sudden 200 deep, 2 wide on 10 platforms. You don't really want all that liquidity. You want 20 on each side. So everything above that is basically considered phantom liquidity. It really isn't a price that wants
Anything
to be
above
traded
20.
upon.
So
Anything above 20.
when
20.
you get hit for 20 on one platform,
You immediately take the others out, and you have different algorithms to be able to put prices back in based on which side of the market that 20 was taken on, where it was taken, what type of trader they think took it. And sometimes you can't get out fast enough because these traders are so fast in these markets they could actually hit you maybe 5 or 6 times. So when you want to do 20, you may do 100 or 120. Now you have to spread your price wide as a bank to protect yourself. So instead of 2, now say that you're 5. And instead of 20, now you're 2 on each side across all venues, and you're slowly going to gear yourself back up to that 20 once you deal with that price. And now it's a hot potato, right? Now you have to, as quickly as possible, get rid of all that liquidity you didn't want, all that order flow you didn't want in different venues in order to be able to get your book back in order. And the other part of phantom liquidity comes from the buy side, from the hedge fund side, the high frequency side. They go out and very quickly post bids and offers into the market and flash them in the market to see where interest is. And by doing that, someone may come and try to execute against it, and they're not fast enough to catch that order. The bank's maybe not, another point-and-click trader's not. So now what you get is a very low fill ratio. So that is also considered phantom liquidity, because you look at the order book, and the order book looks very deep. It looks like you're 200 by 201 pip wide in euro, and wow, that's a great-looking order book. Well, I go in to get a deal done, and I can only get 5 done because the market moves away from me before I can get the rest of the deal done, because these guys can pull their order so fast. And then they come back on top of you on the other side of the market, and all of a sudden you're 3 pips away or 5 pips away from where you want to be. So that's another part of the phantom liquidity problem.
Can you talk about last looks, what that means?
Sure. Last look is sort of a protectionary piece of technology that banks have installed in their APIs that allow them to look at the execution that's being attempted to be done before they actually say it's good. So in the real sense of an ECN, the arbiter of the trade should be the matching engine of the venue. So let's say it's Lava. If a bank A puts a price in and high frequency trader B hits that price, Lava should be able to say unequivocally to both parties that deal's done. With a last look, what happens is that the matching engine says the deal should be done. Let's hold the act back to the buy side, and let's go ask the bank, is this still a good price for you? Are you still okay with doing 5 at this price? And the bank then can say, yeah, no, I just got done 10 somewhere else. I don't like that anymore. No, rejected. And now you have to then send a message back to your other customer to say, sorry, you missed that price. Do you want to post, or do you want to stay out of the market? So it's something that was done out of necessity, I think, back when the banks had inferior technology to these high-frequency traders and were literally getting robbed on a daily basis. If you're in the bank's position, you thought you were getting robbed. If you're the high-frequency trader, you thought, this is the market. You put a price out there. I execute against it. Why are you mad at me?
Right.
So those protections were built in.
Except for those same high-frequency traders may be themselves making markets, and then when they have last look, flashing it back just to see where the market sentiment is.
Absolutely. Absolutely. And again, there you go, right? So it's everybody looking out for their rational self-interest. The bank is looking out for its self-interest, and the high-frequency guys looking out for theirs.
Well, is there any way back from this? Do you see, or is it just guys, the horse has left the barn, that's water under the dam, whatever metaphor you want to mix up here. Are we ever going to get back to a market technology where it's not an arms race?
I think that there, with the right participant, you could make a move to all natural bids and offers, and that's really where people don't understand, who have never been in the world of equities, and they look at FX and they say, well, FX technology is just going to follow equities. Well, the difference is
the equity example there being someone like LiquidNet, all real money guys, all just going for a crossing network, but there's always another place for them to go if they can't get filled on the cross. And
that's right.
There's obviously, eventually got to go back to the banks.
That's right. That's where everything starts and stops, right? So the banks themselves, if you want to draw an analogy, each bank themselves is like an exchange. It's like each bank is like a Nasdaq, or each bank is like the New York Stock Exchange. They are the final destination for execution, and so FX really can't take the same path because there's not the collection of natural bids and offers that exist in the equities world, in the FX world. FX has traditionally been a either request for quote kind of via phone, squawk box, or on the computer, or a streaming price venue where I'm willing to provide you this execution, but it's not something that I necessarily need to do. And you look at equities, all the retail order flow goes to the same location. All the hedge funds, all the real money people all flow into the same area. And the majority of that business is business that needs to get done for a alternative purpose, right, to build a portfolio. And FX just doesn't act that way. So
What's the problem, by the way, of a market which at least has some exchanges versus a OTC market? Bonds have the same problem, I think.
Yep, I agree. I agree. And look, I think there are some players in the market that could make it happen. It'd be interesting to see if they will try to go down that path because it's just a hard road to build natural liquidity. It's just very, very difficult.
Okay. Well, we're going to take a break right now. This has been great. We're going to keep going, but we're going to start part 2 of this immediately afterwards. But those who want to pop off, thank you much, and we'll be back. We were with Mark Smith, and this is the interviews with BuysideFX.